Warren Buffett hosted Berkshire's annual shareholder meeting over the weekend, and during the meeting, he confirmed that Berkshire has continued to sell Apple, which is by far its largest position. There has been dozens of news articles coming out trying to explain why Buffett is selling Apple, and the consensus right now seems to be that Buffett is selling Apple for tax purposes. However, I disagree with this take, so in today's video, I want to play the full clip of Buffett's response as to why he is selling Apple and share my thoughts on what he says afterwards. So let's begin by taking a look at what Buffett has to say.
No, I would. But we have sold shares. I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now. One interesting thing is that Charlie and I looked at common stocks or marketable equities or the things that people love to look at as being businesses. And when we own a Dairy Queen or we own whatever it may be, we look at that as a business. And when we own Coca-Cola or American Express or Apple, we look at that as a business. We can buy really wonderful companies in the market as businesses. We can't buy all of them. All of their shares. We can't buy 90% or 80% or anything like that. But when we look at Coca-Cola and American Express and Apple, we look at them as businesses. Now, there's differences in tax factors, there's difference in managerial responsibility, a whole bunch of things. But in terms of deploying your money, we always look at every stock as a business. And we have no attempt made to predict markets. We have no attempt made to pick stocks. I went through many, many years doing the wrong thing. I got interested in stocks very early, and I was fascinated by them. And I wasn't wasting my time because I was reading every book possible and everything else. But finally, I picked up a copy of The Intelligent Investor in Lincoln, and there was a few sentences in there that said much more eloquently than I can say it. But if you look at stocks as a business and treat the market as something that's doesn't tell you, isn't there to instruct you, but it's there to serve you, you'll do a lot better over time than if you try to take charts and listen to people talk about moving averages and look at the Fed pronouncements and all of that sort of thing. And so that made a lot of sense to me then. And the way I've been allowed to deploy it, Charlie and I talked about this, of course, constantly. It's changed over the years as the amount of capital we have and has changed and all of that. But the basic principle was laid out by Ben Graham in that book, which I picked up for a couple of dollars, and which basically said to me, you've been wasting your time now, but maybe you can use what you've learned or been reading about and put it to better use. And then Charlie came along and told me how to put it to even better use. And that's sort of the story of why we own American Express, which is a wonderful business. We own Coca-Cola, which is a wonderful business. And we own Apple, which is an even better business, unless something really extraordinary happens. We will own Apple and American Express and Coca-Cola when Greg takes over this place. And unless something dramatically happens that really changes capital allocation, a strategy, we will have Apple as our largest investment. But I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets and I look at the composition of what's going on in the world, we find it quite attractive. And one thing that may surprise you, but almost everybody I know pays a lot more attention to not paying taxes than I think they should. We don't mind paying taxes at Berkshire. We are paying a 21% federal rate on the gains we're taking in Apple. And that rate was 35% not that long ago, and it's been 52% in the past when I've been operating. And the federal government owns a part of the earnings of the business we make. They don't own the assets, but they own a percentage of the earnings. They can change that percentage in a year, and the percentage that they've decreed currently is 21%. And I would say with the present fiscal policies, I think that something has to give, and I think that higher taxes are quite likely, and if the government wants to take a greater share of your income or mine or Berkshire's, they can do it. They may decide that someday they don't want the fiscal deficit to be this large because that has some important consequences, and they may not want to decrease spending a lot, and they may decide they'll take a larger percentage of what we earn, and we'll pay it. And if I'm doing it at 21% this year and we're doing it at a higher percentage later on, I don't think you'll actually mind the fact that we sold a little Apple this year.
Here are all of the key points Buffett made in his discussion of selling Apple. So let's start right from the top with the fact that Berkshire has sold some Apple shares. Berkshire sold 115 million shares, which is roughly 13% of its total holding. This is also equal to roughly $20 billion worth of Apple stock. But then the next key point is that Buffett does still plan on keeping Apple as Berkshire's #1 stock holding. This suggests that Buffett is not wanting to sell out of Apple entirely, but he is definitely trimming the position right now. Now, the next key point is that Buffett looks at stocks as if they are businesses. And this is one of the most important points that every single investor should do as well, because stocks are quite literally just pieces of real businesses. The business is what has real value, and the business is what investors can actually value. And what investors are supposed to do is buy or sell the stock based on if the business is under or overvalued in the stock market. And the intelligent investor actually says that investors should buy stocks when the business is undervalued, and they should sell their stocks when the business is overvalued. But you are always looking to the business behind the stock to know if the stock is actually a good buy or if it is a good sell. Or in other words, you look to the business to determine the value of the investment, and you do not look to what the stock is currently doing or try to predict the short-term price movement of the stock. Now, the next key point here is that Buffett makes no attempt to try and predict the markets. And this is another very key point for all investors. Because what Buffett means by this is that he is not trying to time the market by selling his Apple shares, and he really has no idea if Apple's stock price is going to continue going up from here in the short term, or if the stock is going to fall massively over the next month. There is simply no way to know what stock prices are going to do in the short term, and therefore it is not worth your time to try and predict what stock prices are going to do, or buy and sell stocks based on if you think the stock is going to be up this month or down the next month. What this also means is that Buffett is not selling his Apple shares because he thinks the stock is going to go down over the next year or so. Why he is selling his Apple shares is because he is taking a look at the business behind the stock price and arguably thinking that it could be a little bit expensive right now. And all you can do as an investor is base your investment decisions off of the value of the business instead of guessing what the stock price will do in the short term. Moving on to the next key point here, this one is that the market is there to serve you and not instruct you. Buffett brings up this point and then says that he learned it from the intelligent investor. So this is very much so just emulating what the intelligent investor says. And the intelligent investor says that the market is there for you to take advantage of, and it is not there to guide you. Now, what this means is that you have to think for yourself as an investor, and you cannot look at the market and its stock prices as a source of truth. If a stock is priced extremely high, it doesn't mean that it should be. And if a stock is priced extremely low, it doesn't mean that it should be down there either. The market is fueled by emotion in the short term, which allows you to buy stocks below their values when investors are scared or pessimistic, and sell stocks above their values when investors are excited and optimistic. Now, why this is important is because Buffett is using this example when he is referring to selling Apple shares. This suggests that Buffett believes the market is overvaluing Apple stock today, and he is taking advantage of that overvaluation and trimming down some of his position. If we head over to Stock Unlock and take a look at Apple's price to earnings ratio today, we can see that it is trading for a PE of 28 now. If we also take a look at Apple's 10-year average historical price to earnings ratio, it is 20.5. So Apple is trading roughly 40% above its historical average price to earnings ratio, which could suggest that the stock is overvalued today relative to how the market has been valuing Apple shares in the past. Now, additionally, a 28 price to earnings ratio is equivalent to an earnings yield of only 3.6%, which is not a very high yield on the cost of shares. In fact, if we take a look at the 10-year bond yield today, we can see that it is offering roughly 4.5%, which is actually above the earnings yield on Apple shares today. Therefore, Apple shares are not yielding as much as a government bond today. And what the intelligent investor very clearly says is that this means that Apple shares are not selling for a margin of safety. Apple's revenue and earnings are also not really growing. And last week I did cover Apple's earnings here on my channel, and I did say that I do believe a 28 price to earnings ratio for a business that is not really seeing any growth is a very expensive price tag for that business. Apple is also using all of its free cash flow to buy back shares at low earnings yields. And again, bonds have higher yields right now, so the money that Apple is spending on share buybacks could actually create more shareholder value if they simply bought bonds instead. Buffett knows this as well, and this could be another reason why he is trimming down his Apple position. Tim Cook is arguably not deploying Apple's cash in a way that creates the most shareholder value. Additionally, Apple using so much money for buybacks does suggest that it doesn't know what to do with all of its cash and its free cash flow anymore. And again, I am sure that Buffett knows this and is taking a look at these facts as well and could be weighing into his decision to trim down his Apple position overall. Now, the next key point in this video is that Warren Buffett does not mind building cash under the current market conditions. And I do think that this is a very interesting point. The current market condition seems to be that stocks as a whole are very expensive. Again, we already took a look at Apple in this video, trading at a 28 price to earnings ratio, while the underlying business is not really growing, which again is a pretty high price tag to pay for a business that is seeing little growth. The S&P 500's price to earnings ratio is also 27 today, which is roughly a 3.7% earnings yield. This means that bonds are currently offering a higher yield than the S&P 500 or stocks as a whole, which again, if we tie that back to the intelligent investor, does suggest that stocks as a whole and the S&P 500 as a whole is not offering a margin of safety today. It also means that investors could be getting a higher return on their cash if they simply bought bonds instead of investing in the S&P 500 at its current price. So overall, the current market conditions do suggest that stocks are looking quite expensive, so it does make a lot of sense as to why Buffett may want to build some cash right now and kind of trim up his positions while the market is expensive and he can take advantage of the overvaluations going on in the stock market today. I also found this image right here on Twitter, which does show Berkshire's historical cash positions, and we can see that Berkshire did build up its cash position during the tech bubble of 2000. And the reason for this was because Buffett could not find anything intelligent to do because stocks were expensive. We can then see that after the tech bubble burst, Berkshire's cash position did decline because Buffett was deploying cash during the weakness in the market. We can then see that the cash position once again was building in the housing bubble of 2008, and then when the stock market crashed during the financial crisis, Buffett did deploy large amounts of capital and Berkshire's cash position dropped once again. Then over the following decade, Berkshire's cash position did build up slowly once again, and during the COVID crash in 2020, the cash position did fall. Now we can once again see that Berkshire's cash position is at an all-time high, and Buffett is building it once again simply because he cannot find anything intelligent to do in the markets due to the markets being overvalued as a whole. But moving on to the final key point, this one is that Buffett does not mind paying taxes. Now in the video, Buffett did say that Berkshire is going to pay a 21% tax rate on the gains from the Apple sell. He then goes on to say that the tax rate would have been 35% not that long ago, and historically it could have been all the way up to 52%, as he did see 52% tax rates on capital gains in his own investment lifetime. He then stresses that the government can really change the tax rate on capital gains whenever they want to, and due to the government spending so much money right now and running at such a significant deficit, he would not be surprised to see the tax rate on capital gains and overall on corporations increase in the near future. High government spending typically leads to higher taxation on its citizens because the government does have to pay back the deficit and its lending with tax revenue from its citizens. So ultimately, higher government spending and higher deficits does eventually lead to higher taxation on businesses. And Buffett kind of suggests that this could happen in the near future. Now, if taxes are increased later on, then Buffett simply says that his sale of Apple shares when the tax rate was 21% may look like a good move, and the Berkshire shareholders may actually thank him for it if, for example, the capital gains tax rate does go up to 50%, because it ultimately means that Berkshire shareholders will be saving a lot of money by selling their Apple shares right now. However, Buffett does not say that the higher tax rate is why he decided to sell the Apple shares. He is simply saying that the lower tax rate right now could look like a good thing in hindsight if tax rates do in fact go up in the future. So my opinion on all of this is that Apple became such a large position in Berkshire's portfolio, the stock is trading high right now, Buffett wants to build more cash, and he believes that taxes are going to go up in the future. Therefore, it looks like he was looking to build Berkshire's cash position, and he used the large, overpriced Apple position to do so. And for those of you who may not know, in the tech bubble, Buffett held his Coke position despite the stock trading for 70 times earnings. He then wrote in the 2003 letter to shareholders that he regretted not selling some stock during the tech bubble, and it also took Coke 13 years to make a new high. So maybe Buffett also learned from the tech bubble that it can be wise to trim down or sell some of your stocks when they are trading for expensive prices, because overvaluations can lead to a long period of stocks not producing any returns for you as the investor. But as always, I would love to hear all of your thoughts down in the comment section below. And if you did find this video insightful or helpful in some way, then please remember to leave a like on it, as it does really help out my channel, and I do truly appreciate it. Also, if you are new to the channel and you want to stay up to date and see more stock market related news like this and breaking news that does happen in the stock market, then consider subscribing to my channel as well. But with that being said, thank you all so much for watching. As always, I truly do appreciate it, and I really hope to see you all again in my next one.